Well, happy Sunday, everybody. Welcome to the Robinson Report video version. This is the very first time we have done this before. My name is Jerry Robinson from followthemoney.com. And this week we decided to do a Robinson Report video version. You're also going to have access to our PDF slide deck, so you can download that, all the slides. Most of the charts that you're normally used to seeing in the Robinson Report are included in this slide deck PDF. But I'm going to go through several things. We had quite a few things to talk about this week, and so I decided to do a video version. I hope you enjoy it. Sit back and enjoy this. And also you can refer to the PDF slide deck at your leisure throughout the week. First of all, I just want to give you a heads up that we are planning right now the Follow the Money 2019 Summit. We are so excited about what's coming up May 31st. This is going to be an all-day event from 9 a.m. to 5 p.m. in Rogers, Arkansas. If you are a platinum member, a gold member, or a silver member, this is completely free for you. You and your spouse, you actually get 2 tickets to this. Now, there is a charge if you're not a member, and so if you need more than 2 tickets, just give us a call and we can figure out something for you. But normally 2 tickets covers most people, and we really look forward to seeing you May 31st. This is an all-day event. We're going to have all the details. Registration is going to open next week, and so be looking for your in your inbox for details on this. But mark your calendars, May 31st, 9 a.m. to 5 p.m. If you can make it to Rogers, Arkansas, you will have a seat. This is a lovely area. Lots of really interesting area with Walmart being stationed and headquartered right here in this area. And so it's really quite a bizarre, not quite what you would expect perhaps when you think of Arkansas. It's actually very unique, this northwestern corridor up here in Rogers, Arkansas. I think you'll really enjoy it. So anyway, watch your inbox next week. We'll have registration details out very soon. And we're also very excited to announce that the second day of the summit is actually going to be different this year. It's an optional day, and that's going to be June 1st. So May 31st is the completely free summit all day long. We're going to be having guest speakers, lots of great information you'll hear more about next week. And then on June 1st, the next day, which is Saturday, from 8:30 to 4, we're going to do our very first trend trading boot camp. This is an all-day long event that is going to teach you so much about trend trading. If you're currently trying to boost your income with trading, stock trading, ETF trading, this is something you do not want to miss. Even our platinum members or gold members, people who've been with us for a very long time, you're not going to want to miss this. We have an early bird discount of only $297 to reserve your seat. I have to stress to you that we have very limited seating for this boot camp. It's not going to be in the normally, like the large room that we're doing our summit in. So this is a smaller room, and so we're going to fill up quickly. And so if you have any desire at all to take your trading to the next level, this is going to be a very intimate, powerful, all-day event on June 1st, 8:30 to 4. And you can reserve your tickets. Reserve your seat, only $297. Again, registration will open on that next week, and it will fill up quick. So I want to give you a heads up now. Be watching your inbox for details on that. Also, the Wall Street Journal just put out a forecast on legal cannabis sales, referring to Grand View Research, which is the same outfit we have referred to as well. It's a fairly conservative estimate. But if you look at the growth of legal cannabis sales in the United States, you see them topping out over $50 billion by 2025. So this is a fast-moving market, and we just put out our 2019 Cannabis Report and chart book, and that's available at followthemoney.com/cannabis. If you're a gold member or a silver member, it's only $37. If you're a platinum member, it's completely free. So if you're a platinum member, just log into your dashboard. You'll see it there. We put a lot of work and research into this cannabis report. We named 7 stocks that we actually own right now and we're holding for the long term. And we put a few other stocks in there as well that we like going forward. But not just that, we really educate you on how to profit from this global cannabis boom that's coming. It's a wild ride ahead. And so certainly want to let you know about that cannabis report that is out. Gold and silver members, you can pick that up right now for only $37. It's a steal. It's an introductory price. Followthemoney.com/cannabis. All right, let's move into the Robinson Report here because I want to talk about several things here. First of all, the Wall Street Journal reporting that the Fed is signaling that it's becoming even more dovish. And we saw the stock market pop on this news. Wall Street Journal reporting that the Fed has apparently decided to maintain a larger portfolio of Treasury securities on its balance sheet than it had originally planned. And this is quite interesting because the Fed had really planned to unwind its quantitative easing policies, quite more aggressively than what they're signaling now. That all this began in the wake of the 2008 crash, and the Fed started buying up a bunch of bonds, Treasury bonds, and then later mortgage bonds. And what we've seen is that as they've been unwinding this, there's been a little bit of market volatility. Have you noticed in the last part of 2018? As they're winding this down, they're discovering that it's not going as easily as they had expected. So the Fed is expected to privately discuss their future plans over the Fed's balance sheet at a 2-day policy meeting that's being held this week. We may get a glimpse of what the Fed intends to do in Fed Chair Jerome Powell's press conference on Wednesday. Simply put, we just don't expect the Fed to lower its balance sheet back to pre-crisis levels because, A, it really just can't, due to the fact that market volatility would, cause ripple effects throughout the global equities market, and then secondly, because the Fed thinks that it can continue to manage and control interest rate levels despite a higher than normal balance sheet. We'll see. I mean, we certainly are in uncharted territory here. We expect the Fed to lower its balance sheet to no more than, say, $3 trillion to $3.5 trillion, which could become the new normal range until the next inevitable economic shock, at which time the Fed will likely ramp up its stimulus programs and drive its balance sheet even higher through more Treasury purchases. And if we just drill down here into this chart that the Wall Street Journal has put together from the Federal Reserve, you can see how the balance sheet at the Federal Reserve has really just grown so unbelievably since that time. These are trillions of dollars you're staring at here. And so it's trying to unwind these. At the very beginning of the crisis, as they began buying these bonds, they said, we're going to unwind them back to pre-crisis levels eventually. And now that as they're trying to do that, they're discovering that it's more difficult than they had realized. In a separate note, the federal government shutdown in Washington got a 3-week reprieve over the weekend, which should serve to take some pressure off of U.S. stocks in the near term. May see a little bit of a kind of a bump up in stocks next week on this news, but who knows? I mean, it's difficult to know how the market's going to interpret this. But it's also important to notice that the shutdown has merely been delayed. It has not been solved at this point. Turning globally for a minute, the European Central Bank has admitted that Europe's economic outlook has deteriorated since December, and it's signaling a potential new round of stimulus for the region. Short-term interest rates in Europe remain 0 to practically negative 0.4 on the short-term rates, and most analysts don't expect rates to turn positive anytime between mid-2020. If we look at the Bank of Japan, the BOJ, we'll see their key interest rate also remains negative at 0.1%. And then over in China, we're also noticing that China is seeking to prop up lending by lowering bank reserve requirements. They've been aggressively moving in this direction. We expect them to have more in the way of stimulus in the coming weeks and months. Now, fears of slowing global growth, particularly in China, are spooking international financial markets. Early last week, China reported a 6.4 annualized GDP growth rate. And as the U.S. financial media reported on this, they were breathless in their discussion of how unbelievably historic this was, how it had been 28 years since China had something this low in the form of GDP growth. What they're conveniently forgetting, I'm referring here to the financial press, is the fact that the U.S. has not had 6% growth in more than 45 years. And so again, even though China China's GDP growth has slowed. It's slowed to an area that is still unbelievably historic for any particular country over the years. You can see it's, back in the 90s, we were at 14%. You can see this is China's annual GDP growth rate. Even back in 2006, 2007, way up here in the nosebleed area. And so, yeah, we are back at crisis level area GDP growth for China. But again, when you look at the U.S., it's just been mired in negative to subpar growth over the last several years. And we've never been at 6%. I mean, you have to go all the way back 45 years to see that. So, again, the financial media kind of picking and choosing what it wants to focus on. It really should be focusing upon the massive deficits and debts right here in the United States. But the U.S. press prefers to, point at the speck in their brother's eye instead of noticing the mote in their own. I want to remind you, for all of our gold members and platinum members, this Tuesday, be sure to tune into our private group coaching call. We have some really good stuff lined up there. We'll also be looking at some of your own questions, some of your stocks that you want to look at. Love to do that during real-time market hours. It provides a lot of, I think, relevance for many of our newer traders, and also just to kind of give you a heads up of what we're looking at whenever the market is actually open and live. Next week's earnings, here's just a quick snapshot of some of the earnings to watch next week from Earnings Whispers. There's a few on here that really pop out. Let me grab my pen so I can kind of show these to you. A few of them that are just kind of obviously popping out here. As you see, Facebook certainly going to be in focus. Visa. We're also looking at Amazon, which is going to be reporting on Thursday after the close. We also see Altria, which has recently taken a stake in Kronos Group, CRON, which is one of the stocks that we have listed in our cannabis report. So it'll be interesting to see if they have anything to say on that front. eBay also reporting. We also have Apple after the close on Tuesday. So just quite a few major stocks that are going to be reporting, certainly something to keep your eyes on. It will be an eventful week for earnings. Turning to the market tracker service that we provide, the S&P 500 right now, its position trend and its long-term trend are not currently trending. We are just literally in a trading zone here. So there is an unconfirmed position trend and an unconfirmed long-term trend. Not a surprise. As the market, even though it's been rising, when you look at it in a longer-term setting, you'll see that we are kind of grinding sideways right now, and that's exactly what our market tracker is telling us. So right now, there really is no major long-term trend. There is no major position trend, but that could change very, very soon. In fact, we do appear to be on the cusp of a brand-new position uptrend, and that's the very first step to moving us back into a new long-term uptrend. For those of you who are trend traders or learning to trend trade, that's a very important thing to understand. Those position trends precede the long-term trend. Let's take a look at the S&P 500 chart for a minute, and you'll see why we could be in for a little bit of tough time as we move into the next several trading sessions. Although we could blow past these resistance areas, notice right now that the price on the S&P 500 is hovering right about 2664. And if you notice, that right above here, 2675 to 2725 has been an area of concern for us for some time. It was really a wonderful area of support, but now it's turned into an area of resistance. So 2675 to 2725 is going to be tough. At least technically speaking, we could get a catalyst. I mean, if the market loves the fact that we have a 3-week reprieve from the shutdown, we could see a nice takeoff here. But nevertheless, don't forget that even if we break above that 2725 on the S&P 500, you have this flat 200-day moving average, which also coincides with another major area of resistance right around 2750. So this is going to be a really tough area right here. We've kind of had some of the easy stuff out of the way. Now we have to get back into this tight area of former support where you do have a lot of people who might want to just break even from their investment. There was a lot of volume happening here. So watch out, 2675 all the way up to 2725. on the S&P 500. And then if we clear that hurdle, you still have to deal with that flat 200-day moving average that's hovering right around 2740, 2750 in that range. So we do have a lot of overhead resistance to deal with. Would not be getting too comfortable right now with the S&P 500. We do have quite a bit of overhead resistance. One way to play this, if things turn, if we begin to get a pullback, which going back to this chart, you could certainly see that we could run up into this area here and then pull back, right? We could pull back to the 50-day moving average or even the 14, which are kind of converging right now just above 2,600. 2,600 really is solid support right now for the S&P 500, all the way down to about 2,550. You'll notice the volume has been fairly muted compared to the raucous amount of volume we had back on the sell-off. And so the volume has been, stable and moderate, but not just screaming high. I mean, we just haven't seen a tremendous amount of flow of volume here. But nevertheless, it has been a good beginning to the year. The S&P 500 up about a little over 6%, 6.3% year to date. So we are off to a good start, and that is good news for those of you who pay attention to the, to the very beginning, what they call the January barometer. Typically, how the stock market, U.S. stocks do, the broad indices, how they perform in January, oftentimes sets the tone for the rest of the year. And that it's not always the case, but sometimes it is. And as I mentioned when we talked about earnings too, so far about 1/5 of the companies in the S&P 500 have reported Q4 earnings so far this earnings season. This week we're going to get a bunch more, as we had mentioned. And so far, most of the earnings have been positive. So we've seen some upward revisions on a few things. There's still some scary things being reported about earnings globally and global concerns for multinational corporations. But overall, looking like we are having some decent earnings so far, somewhat surprising for some. Now, so one way to play this S&P 500, if we do get a pullback, maybe we get some negative earnings next week, maybe things aren't as kosher as we're hoping for, or some analysts were hoping for. Well, one way to play this, a pullback in the S&P would be the ProShares Short S&P 500 ETF. SH is the ticker symbol, and you can kind of follow along with us if you'd like. We have a daily trading idea put out on this. You can go to followthemoney.com/daily trade and see our details. But you can basically see a $30.43 swing uptrend entry. So we would probably want to buy the short S&P 500 if we break this area, because we could have more downside ahead. And this particular ETF actually goes up by a factor of 1%. At least it's designed to, every time the S&P 500 falls by a factor of 1%. So 30.43 currently on the swing uptrend is what we're looking for an entry with a 28.17 immediate stop loss, and we would raise that aggressively, one to notice. If you're looking at the Bollinger Bands as well, you can see that we are up kind of the upper edge on the Bollinger Bands. And that's also a reason why we could be back down, at least in the near term, but we could certainly break out. There's no reason why we couldn't if the bulls remain in control here. The market breadth we provided to you as well. We put this in our Robinson report every week. Again, just a really important figure here for market breadth that shows you how many stocks within the S&P 500, what percentage of them are trading above their 200-day moving average. That's a really important metric. And you'll see right now about 41% of them are, which is kind of a bearish area, right? And this oftentimes becomes a good time to add to your longer-term positions when we enter into this bearish zone, because a lot of stocks go on sale. But as you can see, we are moving back up now. And once we get back into that neutral zone, you'll see quite a bit of a thaw in the overall market, in our opinion. Same thing here with the U.S. new highs and lows. This is another important market breadth indicator to watch. And you'll notice we just turned bearish. That means that the number of new highs in the stock price highs in the stock market in the United States, there's more of them than there are new lows. And that's kind of a new thing. We haven't really been there since back in September. So that is a fairly interesting development. On market breadth, the U.S. new highs, outpacing the new lows for the first time in some time. Here's a snapshot of the Dow 30. Another reason why we could be in for a little bit of turbulence here. 200-day moving average right here, right above us. Again, we can push right through this. We don't necessarily have to get stopped here, but you can see there are a few things aligning ahead of next week that kind of give us a little bit of pause. Doesn't mean we're not still aggressively trend trading this market, but we're just aware that we're at an area where we could run into some resistance on the S&P 500 and the Dow 30. Turning to the U.S. dollar. The U.S. dollar has fallen on Friday. Particularly, it fell. It fell out of its little range that it had been in here for a little bit of time. As you can see, it slipped below its 50-day moving average, having a tough time there, and also its 14-day. Still got a rising 200-day moving average here on the U.S. dollar index ETF, UUP. This is the one we tend to use when we're trading the U.S. dollar. But as you can see, we're still in this general bullish uptrend in the U.S. dollar on the near term, but we are getting a little bit of weakness, and it is kind of helping other currencies and, of course, commodities, which we'll turn to here in just a minute. U.S. dollar, by the way, declining at the expense of the Chinese yuan, which has been really kind of sideways grinding for a while, and now it's beginning to break out. So we play the Chinese yuan with CYB, that ETF. And so you can see the euro is just going flat, nothing there really to see. But the Chinese yuan beginning to pick up. So certainly worth a look. CYB beginning to pull up as the dollar is showing some weakness. Let's turn to gold here. Physical gold hitting a 7-month high last week as the U.S. dollar lost more ground. And we got a really nice pop on Friday, as you can see, popping up to about 1,300. We really have a lot of overhead resistance looming in this 1,350 area right up here, but we're still a way away from that, so we could certainly rise up to that area. There is some growing bullishness now on gold, especially as the Fed gets a little more dovish and doesn't seem as hawkish as they did. And we're also certainly seeing some excitement in the gold mining space. There's been quite a bit of consolidation going on in the mining industry right now. Newmont Mining, you may know, recently announcing plans to merge with Goldcorp. That announcement came on the heels of Barrick Gold's acquisition of Randgold, one of our favorite gold miners. And more mergers and acquisitions are likely in the coming weeks and months. So gold, again, looking nice on the charts. We have a trade on gold using the PHYS, the Sprott Physical Gold ETF. That's, again, on our daily trade page you can check out. And as you can see here, the trigger price was 10.01 all the way up to 10.21, and it continues to run. So gold still remaining, certainly in a new position uptrend, and also forming a well, we'll get to the trends here in just a minute. Let's move to silver for just a moment. Also holding on to those nice recent gains that they've had, pulling off of that 1390 support. There's really key support at about 1390. This is the area we do not want to see silver slip through. But for now, we're certainly pulling above that. We have some resistance areas up here we're watching on silver. But for now, everything seems to be okay with silver. It's certainly consolidated for several years, but it is we are seeing some strength right here. By the way, you can check out our daily trading diary track record. If you go to followthemoney.com/daily trade, you can find the daily trading archive there. And you can see how some of our trades have performed just recently. We put all of our trades up here after they trigger, and once we close out the trade, and you can see what was the total potential gain you could have made on the stock, how many days did it take to reach that potential gain. It's just a really nice, helpful kind of track record. Okay, so to wrap things up, want to remind you again, May 31st, mark your calendars, 9 a.m. to 5 p.m., Rogers, Arkansas. If you're a platinum member, gold member, or silver member, we have a seat for you. Just get there, Rogers, Arkansas. All the details will be in your inbox next week. Registration open next week for the 3rd annual 2019 Follow the Money Summit. Be looking for that. Also, don't forget our Trend Trading Boot Camp. Very first time we've ever done this before. It's going to be incredible. We've got an incredible curriculum lined up. You're going to learn so much in a one day. It's going to be insane. June 1st, 8:30 to 4. Plan on being there. Remember, it's an early bird discount, only $297. That's going to get you everything, all access to that whole entire day, the Trend Trading Bootcamp. And that price will go up. So if you are all interested in the Trend Trading Bootcamp, watch your inbox next week and be sure to sign up for the Trend Trading Bootcamp. That'll be the day right after the summit. So you can kind of make it a 2-day event for yourself if you're able to come down to the summit as well. And don't forget our 2019 Cannabis Report and Chart Book. If you're a gold member or a silver member, you have access to that right now for only $37. Just go to followthemoney.com/cannabis. Platinum members have access to it completely free in their dashboard. It's been a pleasure providing you this video update this week on the Robinson Report. I think it's kind of fun. If you like the video style of this, and if you want to provide any feedback, shoot us an email, info@followthemoney.com. If you say, hey, I like these video updates, like to see you do these again, let us know. We want to hear your feedback. info@followthemoney.com. God bless everybody. Have a safe and prosperous rest of your Sunday, and we look forward to seeing you on the other side next week. God bless.